Welcome to the Sales and Management Toolbox from Harrison Consulting. This is a website full of resources for sales and account management professionals. Most of them are free for you to download immediately, but one or two of the templates require a little bit of software support, and this video tutorial is about one of those. This video tutorial is about retailer KPIs and metrics. As usual, if you downloaded the PDF version of this KPI chart, print a copy out for yourself and keep it by your side whilst you watch the video so you can make a few notes. Before we go to the template, however, here's a quick fire refresher on retailer profitability, and the model we use here is called the retail wheel. It's Harrison Consulting's proprietary model of how retailers, or any distributive business really, makes money and makes a return on their investment. If you're an experienced account manager or sales manager, you may know this stuff, but it's still a useful refresher and a very simple graphic device which gets really good feedback from our clients. And if you want to access this material for training of your own team, you'll find a slide deck elsewhere on this toolbox site that you can download. So let's look at this retail wheel. The starting point for most businesses is either some starting capital in the form of cash or investors' funds, which we're going to represent by this black line, and we're going to turn that through the first quadrant, which we'll simply call cash, and we're going to turn that into resources from which we can make profit and deliver a return on this investment that we've made in the business. If you ask a retailer what their primary investment is, most of them will tell you that it's inventory. That's not to say that they don't have to cover the costs of real estate and labour and overheads. Of course they do. But the primary and mission critical aspect is the inventory they purchase to run their business. It's a major cost for them, a major drain on their working capital. And that's why retailers are quite concerned to manage their inventory in an efficient manner. It's pretty obvious that inventory needs to be turned into sales, or in this case receivables. Not very efficiently done here because we haven't made a profit by the look of it. What we need to do is have that yellow wedge larger than the cost of goods wedge or the inventory wedge so that we can see that we've actually made a gross profit. Some retailers may call this gross margin or GP. Essentially, it's sales minus cost of goods in its simplest form. Cash-based businesses turn these receivables into receipts pretty quickly, but a retailer with trade accounts may have some difficulties in this area if their customers pay slowly. There may even occasionally be some bad debts and some loss of funds through non-payment at this point here. Up to the top of the chart, and we can see that we need to provide for our operating expenses, which leaves us with a net profit margin here. A couple of things to say about this are that retailers' success is not purely based on managing costs and profit margins. It's also a function of how efficiently this wheel is turned. Every time the wheel turns, the retailer makes these margins. That's why they're concerned about stock turns, because this is a measure of the efficiency of the turnover of capital and the money invested in inventory. So stock turns, gross margin return on inventory, gross margin return on space become significant KPIs for the retailer. And that's why they put pressure on their suppliers to deliver against those KPIs.